Welcome to the deep dive. Today we're tackling a really interesting area, how everyday investors can get access to those high value stocks, the ones that sometimes seem out of reach.
Right.
We've gathered some great material looking at two main ways this is happening. More frequent stock splits and the growing ability to buy fractional shares.
Yeah, two quite different approaches, really.
Exactly. Our sources look at the good and bad for each. And what we want to understand, by the end of our time together is which one offers the most significant and lasting benefits for individual investors like you and maybe for the economy as a whole.
It's fascinating, isn't it? Both methods are essentially trying to solve the same core challenge, letting more people own a piece of successful companies. But their approaches, well, they're quite different. And as we'll see, the impact varies in scope and sort of how long it actually lasts.
Right. Okay, let's dive in. So let's start with stock splits. If you're not familiar, this is basically when a company increases the number of its shares out there and at the same time lowers the price of each individual share. Think of it like taking a pizza.
Yeah.
Cut into 8 slices, and then you cut each of those in half, so you end up with 16 slices.
Right. Same amount of pizza overall.
Exactly. You still have the same amount of pizza, just in, smaller pieces.
That pizza analogy really hits the nail on the head. It's perfect. And our sources highlight several advantages to doing this.
Yeah.
A key one is increased liquidity.
Okay, liquidity.
Yeah, by making each share less expensive, it theoretically becomes easier to buy and sell, which can lead to more trading. Essentially, it's about how easily you can trade the stock without massively affecting its price.
Right. And it's a lot about perception, too, isn't it?
Definitely.
I mean, a stock priced at, say, $1,000 might feel completely unattainable for many people, but after a 2-for-1 split, suddenly it's $500. That feels much more manageable.
It does feel more psychologically accessible.
Yeah, and the data suggests this can really draw in retail investors, folks like us investing our own money who might have felt priced out before. And there's also how the market sees it. It seems like a stock split can be viewed as a sign that the company's management is maybe confident about future growth.
That's often the signal, yes, which can sometimes lead to a temporary increase in the stock price and, how much it's being traded.
And here's something interesting. It can even make it easier for employees to participate in stock ownership programs.
Oh, yeah. How so?
Well, the lower price just means they can afford to acquire more company stock, maybe through options or purchase plans.
Got it. So, yeah, while stock splits can create a bit of a buzz, maybe their long-term impact on actual accessibility is somewhat limited.
That seems to be the suggestion.
All valid points, though. And historically, stock splits have definitely been a primary way to achieve these aims. But the research also points out some important limitations.
Okay, like what?
For one, the positive effects, like on price and trading volume, they tend to be pretty short-lived.
Right. The hype fades.
Exactly.
Yeah.
Unless the company's underlying business is genuinely strong and growing, that initial excitement usually just fizzles out.
Okay.
There's also the potential for increased volatility. Lower prices can sometimes attract more speculative short-term trading.
So more gamblers jumping in.
Sort of, yeah.
Yeah.
Which can lead to bigger swings in the price day to day.
That makes sense. If it costs less to buy in, you might see more people trying to make a quick buck, jumping in and out. And something I hadn't really thought about, the administrative side.
Right.
Our sources mention that stock splits actually involve legal and administrative costs for the companies themselves.
They do. It's not free to execute a split, which can be a burden, especially, for smaller companies.
Interesting.
Exactly. And perhaps the most significant limitation, really, in today's market is that stock splits are becoming less necessary to improve affordability. Well, this is where fractional share buying comes into play and really shifts the dynamic quite a bit.
Okay, perfect transition. Let's dive into fractional shares then. This is a concept that's become much, much more common lately, hasn't it?
Absolutely. It's exploded in popularity.
So instead of needing to buy a whole share of stock, fractional share buying lets investors purchase just a portion of a share, even if you only want to invest, say, a small amount of money.
Precisely. So if a company's stock costs, let's say, $3,000 per share, a big number.
Yeah.
You could, in theory, just buy $50 worth, or $20,
Yeah.
or $100, whatever fits your budget.
Wow. And the advantages here seem, well, pretty compelling based on our sources. The most obvious one is that much lower barrier to entry.
It's huge. You no longer need to save up a large sum just to own a piece of one of these high-flying, high-value companies. You can invest with practically any amount you have available.
That's just a massive leap for accessibility, and the research also highlights that this allows for greater diversification.
Yes, that's key too.
Even with a smaller total amount to invest, you can spread your money across more companies rather than, putting it all into one or two cheaper stocks just because they're the only ones you can afford a full share of.
Exactly. Which is much better for managing risk, as you say.
Makes total sense.
Absolutely. And from a market perspective, this broader participation, well, it naturally leads to more consistent liquidity over time when more people can trade small amounts frequently.
There's more overall activity.
Right. More buyers and sellers active in the market. The flexibility it provides for strategies like dollar cost averaging.
Ah, yeah, investing regularly.
Investing a fixed amount regularly, yeah.
Mm-hmm.
That's also a significant benefit for individual investors like you, the listener.
Right, being able to invest a consistent amount, maybe $25 every week, regardless of the share price. That can really help smooth out returns over the long run.
It certainly can.
And this is the key difference, isn't it? The data emphasizes that fractional share buying doesn't actually require any action from the companies themselves.
No, none at all.
It's something that the brokerage platforms, the apps and websites we use, they implement it. So there are no direct administrative costs for the listed company.
Exactly. It's a much more efficient system in that respect. And fundamentally, it leads to a greater democratization of investing.
Democratization, opening it up to more people.
Yeah, opening up the stock market to a much wider range of people, which could have positive knock-on effects on overall savings and investment rates in the economy down the line. So fractional shares really provide this permanent, granular access to almost any stock.
It sounds almost too good to be true. So what are the potential downsides then? Are there any catches with fractional shares we should know about?
Well, the sources do mention a few potential drawbacks, yeah. Nothing's perfect. One is that it does depend on the platform you use.
Ah, okay.
Not all brokers currently offer fractional share buying, although, it is becoming much, much more widespread.
True. Seems like most major ones do now.
Most do, but maybe not all, or not for all stocks. And the ease with which you can buy and sell those fractions, the liquidity of the fractional shares themselves, can sometimes depend on the internal systems of the brokerage holding them.
Okay, so it might vary a bit between brokers. What else?
Also, there's the issue of voting rights.
Ah, yeah. If you own stock, you usually get a vote.
Right. But if you only own a fraction of a share, your voting rights might be limited or may be proportionate to how much you own. It can make participating in company decisions a bit more complex, potentially.
So you might get like 0.1 of a vote.
Something like that, or the broker might aggregate votes. It depends on the setup. It's just not as straightforward as owning a full share.
Got it.
And finally, there's the potential for fees, Well, it's definitely less common now with the rise of commission-free trading.
Right.
Some platforms might still have slightly different, maybe higher, transaction costs or specific fees associated with fractional trades compared to full share trades. Something to check.
Okay, good to be aware of. So we've looked at how they work, the pros, the cons. Now, let's get to the main point. How do they really stack up against each other? Our sources give us a really helpful side-by-side view here.
Yeah, the comparison is quite stark in places.
When it comes to increasing liquidity, stock splits seem to give like a temporary boost.
Often short-lived.
Whereas fractional shares seem to offer a more sustained and scalable increase over time just by bringing more people in constantly.
That seems right. It's a structural change with fractional.
Lowering the entry barrier, splits help somewhat, lowering the price point.
Fair.
But fractional shares truly allow you to invest pretty much any amount you want.
That's a critical distinction, yeah. The barrier essentially vanishes with fractional shares, financially speaking.
And what about those administrative costs we mentioned?
Those splits are high for companies involving legal, admin work, fractional shares. The cost is mainly on the brokers to set up the systems, relatively low overall.
Okay. And accessibility. Splits improve it, but you're limited by the split ratio, right? Like 2-for-1 or 3-for-1.
Exactly. Whereas fractional shares just maximize accessibility. You're not limited by any ratio. You buy the dollar amount you want.
The duration of the impacts also seems quite different.
Very different. Short to medium term for splits, often tied to market sentiment. But ongoing and structural for fractional shares, it's just how the market works now on those platforms.
And in terms of that democratization idea,
Yeah.
the source clearly indicates that fractional shares have a much greater impact on actually democratizing the market, bringing more people in.
Absolutely. It levels the playing field far more effectively.
Interestingly, neither method directly affects the company's underlying fundamentals, right? The actual business value.
Correct. Neither changes the size of the pizza, going back to that analogy. It's just about how the shares are structured or how they're traded.
And complexity for investors generally seems low for both.
Yeah, broadly speaking, both are pretty straightforward concepts for an investor to grasp. Maybe slightly more involved understanding the mechanics of fractional on a specific platform, like those voting rights, or order execution details.
Okay, so if we connect all this to the bigger picture, the conclusion our sources seem to reach is quite clear, isn't it?
It seems to be, yes. That encouraging the widespread adoption of fractional share buying is likely more beneficial for the overall economy than, say, relying on companies doing frequent stock splits.
And the reasoning behind that conclusion seems pretty convincing when you lay it all out.
I think so.
Oh.
Fractional shares directly address the core affordability issue head on. They open up access to a much wider range of people, structurally.
Right.
And they encourage sustained liquidity and diversification for more investors, all without adding costs or administrative burdens onto the companies themselves.
It really does sound like a more effective and maybe even a fair system overall.
Exactly. Stock splits, they served an important purpose in the past, definitely. But they're arguably becoming less and less essential in a market where fractional investing is so widely available. They just don't offer the same long-term scalable advantages that fractional shares seem to provide.
So for you, listener, think about this. The rise of fractional shares really changes your potential to participate in the market, doesn't it? To build a well-rounded portfolio, no matter how high the price of some individual stocks might seem, it lowers both the perceived psychological barrier and the actual financial barriers to entry in a really significant way. We've all seen those headlines about certain stocks soaring to thousands of dollars per share.
Yeah.
Today, we've dug into some clever ways the financial world is trying to make these opportunities accessible to you.
And this raises an important question, I think, about what the future of accessibility in financial markets might look like more broadly.
How so?
Well, if a seemingly difficult challenge like super high share prices can be largely overcome through technological innovation at the brokerage level,
right?
What other long-standing obstacles, maybe information access or minimum investment sizes for other assets, what else might be tackled with similar ingenuity or maybe regulatory changes?
That's a fantastic point to consider. It really makes you think. So the key takeaway from our deep dive today seems pretty clear. Fractional share buying looks like a more powerful and sustainable tool for democratizing investment compared to the more traditional method of stock splits.
I think that sums it up well. And considering how increasingly available fractional shares are becoming, that final thought is worth mulling over. What other barriers that keep people from participating fully in financial markets might be the next to fall thanks to new technology or new thinking? It's definitely an area to keep an eye on.